But it's really all about the budget and all about taxation. Isn't that the big word that we watch out from every budget? Rajesh Gandhi, partner at Deloitte India, in the studios with us. So Rajesh, hi, morning.
Good morning.
Is there a case for removing or increasing the holding period for LTCG for equities? Because I think from an equity market perspective, that's the key that everyone's looking out for.
Yeah, I'm surprised you're talking of the holding period and not actually removing the tax. Well, I think theoretically, if you see, what is capital gains tax? Capital gains is a reflection of corporate profits, and corporate profits are already taxed once as corporate tax, and then plus as dividend distribution tax. So ideally, there should be no capital gains tax or CGT because it's like a triple taxation. And that's why in most large economies around the world, whether it's US, China has suspended tax, and many European jurisdictions, they actually don't levy a capital gains tax. India does levy for various reasons. I mean, whether it's to try and plug loopholes, tax avoidance schemes, and things like that, or as a revenue generation measure. But I think maybe it's high time we should relook at that. If you remember, in 2004, the securities transaction tax was introduced, the STT. And at that point of time, the long-term capital gains tax started to be exempt because the government felt that STT is a better way of collecting tax, like a withholding tax, and they could avoid any loopholes which people might not pay the capital gains tax. But what happened in 2017? They introduced long-term capital gains tax, but kept the STT where it is. So it's like, one replacing the other, but now both being taxable. So I think there's definitely a case to remove capital gains tax. Markets behave in a very complex manner. The government might argue that, well, you have capital gains tax, but that doesn't reflect corporate profits because markets don't, move in tandem with corporate earnings. So they definitely have a case. And at the same time, your newspaper reported 2 days back that almost 5 lakh taxpayers have evaded capital gains tax. So I think that will probably prompt the government not to remove capital gains taxes. I'm not too hopeful. And also, probably why should the government do that? The markets have been doing so well in spite of corporate earnings not being so great. So I don't think the government will have a lot of focus on boosting the markets, but rather to ensure that deficit is under control. GST revenue, slippage is kept in control by this capital gains tax. So I'm not hopeful of the removal, but I think that they probably might change the holding period, as you said, maybe from 1 to 2 years.
If direct dividend tax moves away to the hands of a receiver, do you think that will be so what government will do is that they will ensure that corporates, they pay more dividends,
right?
And dividend, if it gets taxed in the end of the receiver, they also will continue to receive some tax. Do you think this is like a no-brainer? Simple move, but a no-brainer move.
I think it's a no-brainer, but I think they'll have to be careful because I fully agree with you. On the dividend distribution tax, the government has collected almost about 55,000 crores.
That's a large
number.
That's a large number.
So they will have to really be careful in terms of replace it with the withholding tax, as you said. Then where is the revenue leakage in terms of either foreign taxpayers claiming treaty benefits because the withholding tax rate in the treaty will be lower, senior citizens, or maybe several investors not filing returns. So there could be a revenue leakage there. And also it could probably lead to some amount of additional compliance by senior citizens and other taxpayers because now they have to collect withholding tax certificates, match them with the data from the companies and all. So it could lead to additional burden on them. So I think they'll have to be do a balancing act here. There is a need to remove dividend distribution tax for various reasons. Foreign investors don't get a credit for the tax. Domestically also 20% is a very high rate. But there has to be a balancing so that small taxpayers are not harassed by the removal.
My only logic is that today corporates are sitting on cash in their books. They will not pay out dividend because nobody wants to pay tax.
Right.
That's one. B, if the DDT is removed, then the buyback tax also has to be removed.
Absolutely.
If they both are removed, then a lot of companies may actually consider doing a buyback. And we know buybacks have really been the root reason why US earnings this time have been strong. The Apples and the Alphabets of the world have been doing buyback.
Right.
So even TCS Infy back in the day.
They will also start doing buyback.
Right.
So whereas you may say that, look, I may not get 55,000 crore, I will get some of it, but in a sense, indirectly, I'm able to really give a big booster shot or caffeine shot to the markets and to corporates.
Right. No, I fully agree with that because it has various benefits, as you said, both from a shareholder point of view, company's point of view. It's my prerogative to decide, right? If I want to do a buyback and reduce my capitalization, it has various other benefits. My EPS goes up, my company becomes more efficient. So that choice should be left to the company rather than being driven from a tax point of view.
What is your assessment on how much government has managed to collect through LTCG? Because they were aiming 40,000 crore. I don't think they were anywhere close to that.
But you'll be surprised, and I feel that they might actually touch that figure in a couple of years, because today, if you see, the LTCG is roughly about 18 to 20,000 crores.
Well, they've collected 18,000 crore according to
Yeah,
you.
that's what, in one of the budget announcements it was said. And that is in spite of the grandfathering benefit they have given for the pre-Jan 17.
2017, yes.
2017 Jan. And I think in one of the budget estimates, they said that the long-term capital gains tax, which is exempt, is about 3,57,000 crores.
Yeah, but
If you
that
take a
was based on
10%
the
rate-
market cap, which went higher.
Well, sure.
I mean, I mean, there's some interesting data if you want to refer to it. We may look at the index and say, okay, market's at an all-time high. But that's symbolic, right? I mean, how many folks have really participated? Where is the broader market going? The economy is in a downturn, with the exception of a TCS or a Reliance or maybe, a DMart. Not too many companies have really, Bajaj Finance, not too many shareholders and investors have made money.
Well, true. So they may probably not be able to collect 40,000 crores, but if I look at 20,000 and the fact that there was a exemption for the grandfathering, I think maybe they'll be able to meet somewhere in between, probably about 25 to 30,000. Now, if I compare that with the STT, which has collected only 12,000 crores, it's a no-brainer, right? I mean, the long-term capital gains tax gives a much higher revenue as compared to the STT.
It's always a difficult choice. A bird in hand or two in bush. In case of STT, it's a bird in hand. Markets go up or down, you still get to STT. Markets go down, you don't get any LTCG.
That's right.
That's
Yeah, so I mean, what if they increase STT while leave LTCG unchanged?
Right.
They could do that.
They could do that, but that again has a negative impact on derivative trading, for example, on day traders and other investors. Because for many investors, STT is a huge cost today. Those who are doing a lot of regular trading, and if they increase the STT rate, then people already said that the cost of investments in India, cost of trading is pretty high, with the GST, with the stamp duty, and with the STD and the long-term capital gains tax. So I think they'll have to kind of balance there.
logically, personal tax have to come down. If they don't come down, then the smart guys will play the arbitrage. The arbitrage, I think, is very widely visible between corporate tax and personal tax, right?
Absolutely.
Now, if you bring personal tax down, then there is a problem of collection. If you don't get personal tax down, the arbitrage is so large now that it's going to be misused and it's going to be abused. Misused and abused are the two words I would like to use here.
Right.
So what is the easy way out? Where do you cut personal taxes?
Well, I think not only from an arbitrage point of view, but also even otherwise, because the government wants to boost consumption, promote domestic industry and things like that, there is certainly a case for reducing personal tax rates. And today it doesn't look very fair, right? You have a corporate tax rate of 15% for manufacturing companies, 22% for other companies, and companies get all sorts of deductions, right, for various expenses. Whereas a personal tax, a salaried person pays 30%, and with the surcharge is paying 43% tax on a gross basis without getting any deduction. There's hardly a standard deduction. So definitely a case to bring out an equilibrium there, a balance there from various perspectives.
So what do? You cannot, if you take away from the top bracket, you will fall flat on your revenue.
Right.
If you give something more to the lower end of the bracket, which is 5 lakhs and 7 lakh, 7.5 lakh, that's large in quantity, but you will not
hardly make a difference.
Will not make a difference. I mean, you will end up giving 2,000, 3,000, 3,500, maybe 4,000 rupees maximum.
Right.
Where is the middle path?
Yeah, I think the middle path lies maybe in reducing the personal tax rates to some extent, as I said,
Across
to bring across the board to bring equilibrium. Maybe not at the super rich level, because globally, there's this talk of taxing the super rich more. So maybe not at that level, and they'll have to define super rich for India differently than maybe the US. Do that and look at other ways to raise revenues.
All right. Well, appreciate your time. Wonderful to have you. Well, tomorrow same time.